put this picture of Mark Zuckerberg and his wife on the video, and it is, he represents, I don't have anything against Mark Zuckerberg, but he represents the top 1%. He's in the top 100th of 1%, I guess. But the 1%, or even the top 10%, are doing well, very well. It's the bottom 90 to 99% that are struggling. I will explain. Hi, I'm Ben Reppond. Welcome to my YouTube broadcast. Today is June 18th, 2024. Yes, the top 1% or top 10% are doing well, or very well, generally speaking. I'm going to play a piece for you from Dr. Mark Faber. I don't think I've ever played one from him, but he is a well-known economist. He's in his 70s. Actually, he's in his late 70s, and he's been around for a long time. He has a PhD in economics from the University of Zurich. He's from Switzerland, and he now lives in Chiang Mai, Thailand, a lifestyle choice that he made. But he's well regarded, is connected to a lot of prestigious organizations as a board member or advisor, and I highly regard what he has to say. What we get from him is decades of experience of looking at markets, studying markets, and his own personal experience. He is a contrarian. He's viewed as a contrarian. Some people would even characterize him as a perma-bear. But I think what he does, and I just want to give this context, I think what he does is he looks at the intrinsic value of everything: stocks, bonds, commodities, etc. And we know that the stock market, stocks are crazy elevated. And so he's speaking to, and you say, where's the intrinsic value when you have these very high multiples, and or if you have money, currency, printed money, paper with nothing behind it. All of the printed money that's gone on for probably the last 50 years, we have not added 1 ounce of gold, to my knowledge, to the gold reserves. And yet, so everything from 1973 forward is, I think it's fluff. And so if he calls it and says, this is crazy, this is not going to the moon, and this paper is not worth anything unless we agree it's worth something, that's actually true. So his skepticism about markets, both stock markets and bond markets, are probably well-founded, but he has a lot of wisdom. So I love to listen to him. So I'm going to play a piece from him, and he talks about this top 1% to top or top 10%, and that the remaining people are struggling. They're having a hard time making it. And while some are getting richer, some are falling further behind. Most are falling further behind. So take a listen to Dr. Mark Faber.
So there are many surveys in the US which seem to indicate that about 2/3 of Americans live paycheck to paycheck. And I live here in Asia, and I can observe the Asian economies fairly well because I travel and I go out and I mix with people. I mean, the Thai economy is probably the worst in Asia, and the stock market has performed also miserably. But it's still kind of indicative. I have a friend, he has a restaurant, and he told me his figures precisely over the last few years. Say, after COVID, the traffic in his restaurant increased, and this year, May, June, is the worst he's had on record.
So the reason I played this piece from Faber is because you'll hear it from me and you'll hear it from others that things are fantastic, they're wonderful when it relates to equities. But you will also hear that the economy is struggling. Parts of it are struggling. The AI part, the large cap growth stocks are doing very well, but yet others are not. Matter of fact, many are negative earnings, and the price is down year to date. Many. And so when you hear both of these things, I wanted to give you some information to kind of separate that out a little bit between what is causing a negative view and then the portion which is positive. The next one I'm going to play is from John Spallanzani, who manages a family office in New York, and he makes the case we are still in a bull market, and we are, equity market. We are. And we have been invested all or virtually all of this year. We may have been out of the market just momentarily, I think, but we have participated in the large cap growth market and have done well. So I'm pleased about that. Of course, we do that mathematically. And but that's what he's talking about, is that this is the part of the market that's doing very well. AI stocks and other tech stocks are moving up. And he says, go with the trend until it's not the trend. And that's exactly what we do. And how far can this go? It cannot go to the moon. I believe in cycles, and we will become part of another cycle. But for now, at least for now, it's continuing up way beyond and way faster than most predicted, and I would admit faster than I even predicted. So take a listen to John Spallanzani.
On Wall Street, the Nasdaq trying now for its fifth record close in a row. Quite a streak. Both averages now on pace for a winning week. Here to discuss what is next for stocks, John Spallanzani of the Miller family office here at Post 9. Welcome back.
Hey, thanks, Scott.
So you're still bullish?
Still
That's
bullish,
what I
yep.
gleaned from your notes. We're in a bull market, therefore we're bullish.
It's pretty simple, right? Yeah, we try to keep it simple.
There's got to be more nuance than that, no?
No, I think what we saw coming into the year, people were off sides, obviously. Mm-hmm. They didn't believe in the AI story. They front ran a recession that never took place. As Peter Lynch says, more money is lost waiting for a recession than actually in the recession itself. So I think that's what we had. And now we see that the data is normalizing, and the Fed is hopefully going to normalize rates soon, even though they said that they weren't going to be too fast on the trigger.
Okay,
with
so
normalizing
you
rates.
said you used the word hopefully.
Yeah.
So are you worried? I just had a conversation with Leisman. I know you heard it.
Yeah.
Are you worried about the Fed staying too high for too long and making a mistake?
Well, I think I said it with you a while back, but we don't want to have a soft landing, which the market is now discounted, turn into a crash landing, which is what we could if they stay higher for too long. Obviously, they're higher for longer because they made a huge mistake when they said inflation was transitory. So they've had to walk that back, and they're still trying to walk that back. But yet we see the inflation has really come back to where it was. He actually mentioned 2019, and I pulled some data from 2019 about PCE, inflation, and unemployment, where it was back in 2019 prior to the COVID pandemic. And really, it's kind of back in that range where we were between 2017 and 2019, let's just say. So basically, everything is normalized except the Fed. So we're not making rate cuts to ease. We're actually making rate cuts to normalize. And we have the Bank of Canada cutting rates. We have the ECB cutting rates. We have the Swiss National Bank cutting rates. And the Fed is doing nothing. So them doing nothing puts a lot of uncertainty into global markets, not to mention what we saw in France today, Macron, as well as the as well as the markets over there. And after Powell's press conference, what happened? Dollar yuan went back towards 160. The euro weakened, and if we look at yield curves around the globe, yields are still up rather than down, which is where they should be going right now.
Is that why you guys continue to lean into mega cap tech, whether it's Nvidia, Meta, Microsoft?
Amazon,
which you've been, Amazon, of course,
yep.
Which you've been adding to. Most of those names on your list you've been adding to over the last month.
No, we have those names. We haven't added to them over the last month. NVIDIA is a huge move. Last time we were on May 2nd, I think it was 800. Now it's 1,200. Split adjusted, it's 120. So those trends. I mean, people say, why has NVIDIA gone up so much? Well, earnings went from $2.50 in talking split adjusted, $2.50 in 23, and they're expected to do $37 in 26. That's a huge move. So obviously the stock has had a huge move. They have a huge moat, a huge stack, and AI is a secular trend that people call it the next electricity, whatever. Even Eric Schmidt said we haven't seen anything yet in terms of AI. So those are big secular trends. Not to mention the government printed $5 trillion. So all that money went into the big is beautiful, right? The big stocks, big balance sheets, big moats, big everything, and they were kind of they took advantage of all that cash. Yet we still see regional banks, KRE still under 50. We see Russell struggling today. Why? Because they need cuts. And we also saw, just coincidentally, Caterpillar, some industrials and materials started to quake a little bit because the Fed was so hawkish.
So finally, I want to play a piece from CNBC, and the piece that I'm focused on is kind of a panel there, and the one that I'm focused on is Josh Brown, and who's from Ritholtz, and he makes the case. He says it very bluntly: get out of cash. And when he says that, I listened to this carefully. What he is referring to is short-term debt instruments, short-term, or actually just cash. Get out of cash, and he makes the case, get into long-term duration treasuries, and he even implies and mentions equities. So I would say get into long-term fixed income instruments and into equities, if I'm reading what he's saying correctly. So take a listen to Josh Brown.
Potential upside. They believe that the S&P has even greater upside. Josh Brown, where do you stand?
Look, I have a message for everyone watching this. If you want to know what professionals are, or at least should be telling clients right now, it's very simple. Get out of cash. Get out of cash. If you have money that you're not using next year, later this year, tomorrow, and it doesn't need to be that liquid, if you have a 3-year, 5-year, 7-year time horizon on that pool of money, I want you to consider extending duration. I'm not asking you to take credit risk. You could do this with treasuries, no problem. But you are going to now see rate cuts. You're seeing softening in the data. The rate cuts will be justified. I'm not saying you're going to see some sort of massive economic turndown, but I think your days of 5.5% yields risk-free are coming to an end. I don't know the exact date. I don't predict interest rate moves, but it feels very likely to me that the smarter bet, if you look back 5 years from now at a portfolio, the smarter bet will have been to extend those durations, accept less overnight yield, but have that runway so that you're earning more over time. We did this for clients between February and March across all of our asset allocation models. It was the first time we had shifted back into fixed income from cash since 2020 when we went the other way, when you weren't being paid for duration at all. You're about to be. It's not tomorrow, but it's coming. So I want you to start thinking about that strategy. I think the markets are getting it. State Street is out with some research this morning talking about ETFs. $90 billion came into ETFs in May. That is roughly a third of all of the inflows for the year coming in 1 month. Remember selling May? Nobody listened.
Yeah.
They went the other way. Of the $90 billion that went into ETFs, $60 billion went into equities, but $30 billion went into fixed income. Because I think the message is starting to hit home that this is not going to be forever. So that's where we are right now, and that would be the thing that I would say is my biggest takeaway from what we heard this week and what I think we heard this morning.
A friend of mine, Brian Schreiner, writes a blog, and I read the blog every week. And last week he wrote something, and I want to quote it to you. He says, well done. He follows my podcast, and I follow his blog. And but I have respect for him, and I wanted to just read this because I thought he said some things. There were a couple of paragraphs that were, I thought they were significant. So he said this: the change in sentiment on Wall Street is something the average American has been feeling for some time. According to a poll conducted for The Guardian newspaper, 55% of Americans believe the economy is shrinking, and 56% think the U.S. is experiencing a recession, even though the economy has been growing. 49% believe the S&P 500 index is down for the year 2024, but it is actually up more than 12%. 49% believe that unemployment is at a 50-year high, but it's actually at a 50-year low. Now, the reason I read this is because it's interesting perception. People are living in their own reality. Their world, things don't look very good. The average American, I'm not talking about the top 10% or top 1%, I'm the average American, the world doesn't look very good from here. And so the perception versus the reality is different. And then we've got this thing going on with AI stocks, NVIDIA in particular, but AI in general. And so he wrote the following. So I just think this is interesting. As you look back, if you remember this, if you're older, you remember this. During the tech bubble, so this would be the late 90s, Intel chips were all the rage, and the stock soared 300% in 2 years. If you remember the late 90s, you will remember that Intel was the darling of the tech stocks, and tech stocks were, particularly .com stocks, were leading the growth up. But Intel, of course, is an infrastructure company. Today, Intel is trading at 60% below its all-time high. Almost 25 years later, and the hype has again reached a fevered pitch. They say AI is going to take over millions of jobs and do everything better, cheaper, and faster. The applications are limitless. Here's an idea. Use AI to keep spam messages out of my email and to stop robots from calling my cell phone. Now that's a good idea. Someday AI may live up to the hype, but don't hold your breath. I'm not against AI. We use it. We've just started recently, the last couple of months, have started using it in our investing models. It is amazing. It is producing results beyond what I expected, and I'm very pleased about it. I, I don't know what the future holds. All I can say is it works. Great application in the investing world, at least that's what we have found. And there's applications in everything. I know that there are ways that it can be used to a detrimental effect. We probably can't stop that. But it's interesting when people are investing, they're investing in, whether it's Intel and chip stocks or it's in AI, the world gets ahead of itself. So AI has gone up a lot. Why? Because it's making that much more money. It's doing well, but the investors are getting ahead of the numbers. And so, as Brian said here, be careful. Because, I'm not saying it's going to drop as much as Intel did, but maybe a correction is coming. A long time ago, Treasury Secretary Janet Yellen was a little girl. So this is a cartoon that depicts her blowing bubbles, learning about bubbles. Now, before she was Treasury Secretary, she was also chair of the Federal Reserve. So she's got two parts of her resume that are impressive, the Fed and Treasury. Did she learn about bubbles and therefore help create a bubble, both at the Fed and the Treasury? I don't know. And the reason I put the Treasury in there is because it's just my own opinion. But when you're at the Fed and you're in charge of printing money or bringing about digital money, expanding the supply of money, or contracting it, when you're in charge of that and you expand it by trillions, that's called printing money, even though it's not technically printing. When she goes over to the Treasury Department as the Secretary of Treasury, the Congress is spending money that they don't have, we don't have as a country. The previous Congress did the same thing. The previous Congress before did the same thing. So in eras of Republicans and Democrats, they're both big spenders. I think the Democrats are big spenders because they're just big spenders. I think the Republicans are hypocrites because they pretend not to be, but they are. Both of them just spend money and run up the deficit. Here we are at about 35 trillion and climbing. Nobody cares. Nobody is saying, wait a minute, we can't pay for this. This cannot go to the moon. How about we just pay the interest on it? Stop digging a hole. All of that. Nobody is saying that. And of course, Secretary Yellen, she's in charge of this at the Treasury. You may say, well, the Treasury, that's debt. That's not printed money. True. But if you have no intention to pay back the money, all you're doing is just digging a deeper hole and never pay back a nickel of interest or principal, what's the difference? You're throwing money into the system. Pretty much the same as the Fed, at least that's the way I see it. So who knows if that was what her life was like in 1951. So thank you for watching. If you have questions or comments, leave them in the comment section below.